Former Fed economist Claudia Sahm, as we all know, the Sahm rule, I'm sure you've been hearing this left and right, is now stating, well, the rules have changed.
Then I'm saying, well, then why make the rule in the first place? Because I have used your name so many times about this summer, because we basically went up enough to where it should apply. Why doesn't it this time? And simply put, if interest rates or if unemployment, if the rate goes up enough, you would expect a recession. You don't expect it this time.
I don't think we're in a recession right now. Frankly, the Sahm rule has triggered. It's hit its 0.5 percentage point increase threshold that historically would happen in the early months of a recession. Not a forecast, happens in the early months. And the U.S. economy is not in a recession right now. Now, the Sahm rule, using the increased unemployment rate, is picking up on a cooling, a weakening in the labor market, but that's not all that's there. We do have a still very disrupted labor market. We have a lot of labor supply coming in.
As we heard from Claudia, circumstances are different, so maybe this time is different, but too many things are flashing red for me to be comfortable. Let's start out with the Sahm rule once again. Well, the Sahm rule that she's going back on that states anytime you get a 50 basis point move in unemployment, that is a signal for recession. And how accurate is that signal? Well, ladies and gentlemen, it's pretty much 100% accurate, as we can see through history. We get an uptick in unemployment and we are in a recession. We get an uptick in employment and we are in a recession. And where are we right now? Well, signs are saying we could actually be on the cusp of recession as of today. I'm not so sure that is true as of right now, but I do think the clock is ticking, and I'm talking about maybe a few weeks, possibly a few months. We will be in a recession, but the government won't confirm this recession until we're 6 or 7 months into it. Just like everything else, we are late to the party. We were late to raise rates. We're going to be late to cut rates. And history has shown us that we never really land this soft landing that everybody's hoping for. But hey, you can hope in one hand and crap in the other. Tell me which one you think fills up faster. So let's just say the Sahm rules are relevant at this point in time. What else are we taking a look at? Anytime the yield curve uninverts with nearly 100% accuracy, we get yields normalizing. Fast forward a few months later, we're in a recession. 2007, we get yields normalizing. Fast forward to almost a year later, we're in recession. 2019, yields normalize. Fast forward to about 6-7 months later, we're in a recession. And currently, we just had yields normalize, which is telling me that when we add the Sahm rule to the yield curve inversion, I imagine that we are probably 6 to 7 months away from being in a recession. But once again, the government will be late on telling us when we are in a confirmed recession, which means we'll probably be 8-9 months into it before we really know what the heck is going on. So when we go through history, what really happens to the market when the Feds cut rates? Now, I don't want to repeat myself, but we did break down 2007 to where we are today. In both 2007 and the upcoming Fed rate cut, both happened in September and both charts are almost identical, which means we're most likely going to see newer highs in this market on the initial rate cut, but hold your horses, watch the video above because it does get uglier as time progresses. But the one thing I want to point out here is during rate cuts, we've seen 2 market outperformances and 2 market underperformances. 1995, we had nearly a 22% rally. In 2001, we had nearly an 11% decline. In 2007, nearly a 18% decline. And in 2019, a plus 11.5%. In 1995, the S&P 500 was trading right around 14.5 times earnings. The PE ratio on the S&P 500 was sitting right around 14 to 15. So from a valuation standpoint, it made sense that stocks could actually outperform because they were trading so cheap. In 2001, the S&P 500 PE ratio was sitting closer to 42 times earnings, which is historically expensive. So a decline on this Fed rate cut would make sense. In 2007, the PE ratio was sitting right around 21 to roughly 23 times earnings, depending on the time frame you were looking at, and that's historically expensive. It's actually expensive by roughly 10 to 15%, and take a look at the decline that happened in the S&P 500, a 17% decline. And in 2019, we were trading right around 21 times earnings, which is a little rich, but nothing too crazy. So looking at valuations at those levels, I would say it could have went either way. What we have to figure out is the current rate cut that's coming in September. My thought is initial knee-jerk reaction is going to be a rally. but I do think we are going to have severe downside risk as we're trading at 27 times earnings, which is kind of in line with 2007 of that 17 to 18% decline. So multiple things that are actually pointing to us looking a lot like 2007. Now, whatever's going to break is going to be a different story, but as we can see here, the valuations are almost identical to the Fed's cutting patterns. Now we can see from a PE standpoint, we're trading at pretty high valuations, and when a Fed rate cut comes, as I stated, I think it really looks a lot like 2007, but of course I can be wrong. We could ignore the Sahm rule. We could ignore the fact that the yield curve is uninverted, because Wall Street is telling us that this is still a bull market and we should be ignoring anything at this point in time, including if a missile hits us tomorrow. We probably should ignore that and buy some more stocks. The interesting thing is the Buffett indicator is now flashing red along with valuations getting a little hot here. So when we take the total stock market value versus the annualized GDP, what we're expected to produce as a country, we're basically trading at 202%, which is extremely, extremely high. How high is this? This is a 63% premium, or about a 2.0 standard deviation. Extremely, extremely rich, to say the least. Now we take a look at gold prices being up 36.36% over the last year. This to me is an alarming signal that people are flocking to safety, and there's a lot of global uncertainty taking place here. It is rare to see gold perform this strong without any sort of problems lurking in the background. Now, while gold is skyrocketing because people are flocking to safety, we're noticing oil prices are tanking, doing nearly the mirror opposite of gold. Gold is up 36%, oil is down 22%. Why is oil being down a signal? That is a signal for demand destruction, meaning that the economy is slowing and there's not going to be as much demand for oil out on the market because we're not going to be doing a heck of a lot. And that's what the market is pricing in at this point in time. So with an S&P 500 trading at 28, pushing 29 times earnings, number one, valuation seems a little bit high here. Is the S&P due for a correction? Possibly. But even if we take that off the table, the yield curve uninverting has been a signal of recession with about 90% accuracy. The Sahm rule has been 100% accurate, and that's flashing recession. Gold and oil prices are saying that there is a demand destruction coming around the corner. And with the Feds cutting rates, that means that they're trying to control the labor markets weakening. And as we all know, they're normally very late to this game. When I add all of that up, I would say that there is a probability of over 65% chance we are going to be in a recession at the end of next year. And you're probably asking yourself, why the end of the next year? Well, I do think there's seasonality coming here. We have Thanksgiving and Christmas. There's going to be an overhiring taking place. Then you factor in that consumers do have a lot of savings still on the sidelines. Over $6 trillion in money market accounts that I do believe will dwindle down as the year progresses. The one thing that's holding up this gig economy is going to be the labor markets, and I can poke a million holes in those labor markets, and the government can only keep them propped up for so long, in my personal opinion. When everybody's driving Uber but nobody's ordering an Uber, you're going to have a problem with these labor markets, guaranteed. So while most of Wall Street is telling you to ignore these signs, I'm not saying you need to do anything crazy, but I would say the majority of these signs are pointing to a high probability of a recession coming in the near future. As I stated before, I do think we'll probably hit new highs in this market after the first rate cut, but then the clock is absolutely ticking come to the beginning of 2025. As always, appreciate your time. We will see you in the next one.